Hello everyone, I'm the host Wu Tianxiao. Welcome to the 3 minutes economies. The key economy this time is quantitative easing. As we all know, the circulation of money is like the blood of the country. When the blood wells become congested, the flow speed of blood will slow down. At this time, the need of the drop treatment will lead the sentence such as the lower interest rate, increased consumer, and so on. If none of drops don't work, this is when the shot in the arms. Quantitative easing is needed. Quantitative easing, QE for short. The economy is still not recording, with the government interest rate either very low or zero. That's when the government start quantitative easing. The central banks convert the credit from the commercial banks into cash by buying bonds, which include the amount of monies in the market and produce momentum for the market, instead just printing money. Quantitative easing refers to the central bank's large-scale purchase of TB and the other assets, increase the basic money support and increase the liquidity of the market. That is the way to encourage spending and borrowing. It is important to know that the TB purchased by the QE are not the new bonds issued by the Treasury Department. There are the old bonds that are already in the market, so there are no question of the printing money for the treasurers to spend. Why is the quantitative easing such a shot in the arms? That's because in the normal interest time, the central bank tend to the finance interest rate by buying the short-term bonds in the market. The government bonds invoiced in quantitative easing are not only huge in amount, but also relate along in cycle, so that if the effect to increase the liquidity are even greatest. After the implementation of the policy of quantitative easing, the LM curves will move to the right, which is equilibrium. At this time, the balancing of the payment deficit will occur, which devaluate the dollars and increase the export of United States. The IS curve and the BP curves will move to the right at the same time and reach the equilibrium again. It can be seen that the effect of the policies in an opening economy are greater than a closed economy. Actually, the QE comes late. It was a formula formally proposed by the Bank of Japan in 2001, from 2001 to 2006, in order to deal with the continued decline of the Japanese economy and the decline of the investment and the other problems. The banks of the Japan are in a very low interest rate situation. It rejects the liquidity into the banking system through the large and sustained purchase of the government bond as well as the long-term bond. As a result, the bond have been able to live in the lower interest rate. That's turn increase the money supply throughout the economy. In 2006, the Japanese government hold 78% of the bonds, and the basic money support rose to the 20%. and the interest rate was 0.1%. Eventually, the assets rose from the 30% of GPA to 22%. Some scholars believe that was the Bank of Japan took the initiative to increase the money supply. Japanese economies recovered in 2006. However, some scholars believe that the negative impact of the quantitative easing on the global economy, as well as the cycle rate in the future, are not enough to be called a good policy. Thanks for watching. See you next time.